Hi, I'm Coach Gabby. Let's dive into a topic that can significantly impact your real estate investments: how to legally avoid taxes on rental income. It might sound too good to be true, but stick with me and I'll break it down. First, let's clarify. Rental income is taxable. If you're earning $1,000 a month, that's $12,000 a year, and yes, you owe taxes on that. But here's where it gets interesting. The tax code treats rental properties like businesses. Businesses don't pay taxes on their gross income. They pay taxes on their profits after deducting expenses. This is where real estate investors can really benefit. Think about it. When you own a rental property, you're collecting rent, but you're also paying expenses. The mortgage interest? Deductible. Property taxes? Deductible. If you have to fix a broken heater or repaint the walls, those costs lower your taxable income. Even landlord insurance, utilities you cover for tenants, property management fees, and the miles you drive to your property can be deducted if you keep good records. Now, let's talk about a powerful strategy that many overlook: depreciation. When you buy a rental property, the IRS allows you to treat the building, not the land, as an asset that loses value over time. You can deduct a portion of the building's value each year, even if the market value is increasing. For most residential properties, this depreciation occurs over 27.5 years. So if your building is worth $275,000, that's about $10,000 a year in deductions. This isn't cash you're spending, it's a paper loss that reduces your taxable income. You might be wondering, what if I still owe taxes after all these deductions? Great question. If your total income is under $100,000, you can use up to $25,000 of rental losses to offset your income from a job or business. If you earn more, don't worry. There are still strategies to benefit, especially if you or your spouse work in real estate. This brings us to a key designation: real estate professional. If you work at least 750 hours a year in real estate, and that's more than half your working time, you may qualify. This status allows you to deduct unlimited rental losses against other income, which can save full-time investors or real estate couples thousands. Now let's discuss what happens when you sell your property. You've built equity, the property has appreciated, and you're ready to cash in. Normally you'd owe capital gains tax, but not if you use a 1031 exchange. This legal strategy allows you to sell one property and reinvest the profits into another, deferring the tax entirely. You can keep rolling those profits forward for years, and in some cases pass properties to your heirs tax-free. Let's look at a real-life example. Imagine an investor earning $2,000 a month in rent, $24,000 for the year. They pay $7,000 in mortgage interest, $2,000 in property taxes, and $3,000 in maintenance and insurance. That drops their taxable rental income to $12,000. Then they apply depreciation, about $8,700. This brings their taxable income down to just a few thousand. After factoring in mileage, travel, and other deductions, they hit zero. Legally. No tricks, just smart use of the tax code. So if you thought owning rental property was a tax burden, think again. Done right, it can be one of the most tax-efficient ways to build wealth.